Hello and welcome to Headspring's Insight videos on COP26 and sustainability. In the wake of COP26 conference held in Glasgow in November, companies are now digesting what it means for them. To talk about where the corporate world stands today and future actions around climate change, I'm joined by Silvia Pavoni, editor of the Sustainable Views, which is an FT platform on sustainable finance and ESG policy. Silvia, welcome.
Thank you.
Let us start. Perhaps you can give us a summary of the key issues facing companies around emissions targets and whether you think COP26 could be seen as a success or a failure.
So what was achieved at COP26 is, whether you look at it as a positive or negative, is highly contested. And perhaps most people tend to look at it as maybe a little bit of a missed opportunity. So some of the announcements, I'm thinking about deforestation, for example, were positive, but then you also had some of those governments committing, in theory, to those deforestation targets kind of falling short of actually doing something impactful, for example, Brazil. But equally, it was an interesting COP because I think it really became the finance COP. So for the first time, I think arguably it's fair to say that the financial services sector was very much present and often even driving discussion and putting down commitments. Again, we can look at it with a cynical eye and think, well, it's really easy to just make these big announcements in front of so many people and surrounded by important government representatives and your peers. And then when it comes to actually implementing those commitments, that's where we are really going to see whether all those big finance CEOs are prepared to follow through. But there was an interesting announcement in Glasgow, so the creation of the so-called G funds. And as you know, sustainability is very much an alphabet soup of all these various initiatives. So G funds is the Global Financial Alliance for Net Zero. And so we had so many companies, so many asset managers, asset owners, banks, putting their weight behind reaching net zero. And so in total, those companies represent $130 trillion worth of assets. And so capital, they say, that is ready to come into action to reach those net zero targets. Again, very early to see really where we're going with that, but it was an interesting sign, I think, of the discussion moving from governments to the private sector and now to financial services.
Okay, so if we just stay with the private sector generally, what are the main issues generally for companies before we then delve deeper into the financial services sector?
Well, so many. So transparency is a big issue. Making sure that companies are held accountable and know what happens throughout their supply chains. As you know, the EU tends to take, in Europe, the European legislators tend to take more of a sort of mandatory approach when it comes to these things. And they have put together a proposal that will actually hold companies accountable for human rights breaches, for example, that happen throughout their supply chains. So that's just one thing that you may think it's, of course, they should be held accountable, but how do you even go about tracking that information and ensuring that then you disclose it appropriately and then that the authorities actually take action to ensure that any kind of breach doesn't go unpunished.
Okay.
So that's, for example, one of the many challenges that they face. And then, of course, you start thinking about the way that they produce their products, not just the products, but the packaging that goes around the product, the channels through which they distribute the product.
Okay.
It's a very complex, of course,
So there's a huge array of issues. So let's now narrow things down to the responses of the professional services companies, legal and financial. What are the obligations, the targets, and the challenges that they specifically will typically face?
So some of these targets are self-imposed and they come from pressures from investors, from shareholders, but also from the public. And so you would really struggle to find a big company, be in manufacturing or even energy, and in financial services that doesn't have a policy that relates to environmental, social and governance factors, or a policy that drives towards net zero. Now, for a financial services company, of course, the majority, arguably, of your contribution to CO2 emissions come from the money that you put, that you either lend to companies or if you're an asset manager, you invest into companies. And so it's really important for them that they keep an eye on what they do in that respect. So a lot of them will have, again, policies, exclusion policies, for example. They wouldn't work with certain companies operating in certain sectors, but also they would start asking questions, for example, to clients. How do you manage your, again, supply chains? How does your environmental policy look like? But all the way down to even questions that would follow under the S umbrella, so the social elements of or component of ESG, and that would include even board composition. Do you have enough women on your board? What about your senior management sort of at those levels? How does your company look like? Mm-hmm. So there is quite a lot of action, quite a lot of talk, and critics would say that there is more talk than action. Equally, for some of these financial services companies, actually also quite difficult to win themselves off certain sectors and to really being able to address capital, to channel capital towards the right activities. When it comes to actual requirements from the regulators, we also are seeing those, particularly again in the EU, but also in the UK, you have disclosure requirements. You have the financial disclosure regulations coming out of the EU that tells an asset manager, for example, if you say that this is an ESG fund, you really need to show me what you mean by that. And so all of these norms go towards avoiding, in theory, greenwashing and ensuring that again, action follows.
So it's partly legally supported, but it's also the leverage that comes from the investors and the amount of funds that are available. Is it working? I mean, is it working to change policy, this idea that if the funds don't flow, you just won't get the investment, so you have to change?
It's an interesting question because, of course, everyone would tell you that if you have this policy, means that an issuer, for example, a company that wants to raise debt on the back of a green project would access a wider, interesting pool of investors, and in theory receive better terms in exchange. It is still to be proven, I think, that highly polluting companies actually are being cut out of financial services and of capital. So that really has to be proven because if you do have banks that, for example, refuse or starting to refuse working with certain companies, then you probably still going to find some other institutions that are willing to lend money or invest in those companies. But there is a growing movement towards, again, green issuances. So when we think about bond issuances, that's a market that has been growing for years. And we have, of course, it depends also on how you look and how you define what is a green bond. But one organization that looks at these things is the Climate Bonds Initiative. And they believe that by 2025, there is going to be every year $5 trillion worth of green bonds being issued, which is actually quite high. In addition to those, we also have other debt instruments that relate to the social elements of ESG, or sustainable bonds, which include both green and social elements, or sustainability-linked bonds that look at the transformation of the company, the overall goals of the company towards becoming better, both in environmental terms, but also in social terms.
So is there a critical mass of funding that one needs, or a percentage of the total that will finally swing things? Is there a kind of tipping point where you really can't get enough funding without actually being green? Or are we a long way from that?
The question is when ESG will become redundant, and when ESG bonds will just be bonds, or ESG lending will just be a regular loan. I think we're a little bit far off from that happening, but kind of getting closer a little bit at the time.
We're heading in the right direction. Thank you very much, Silvia. Thank you for being with us, and we'll speak again later.
Pleasure.